Hello, everybody! Yay! I'm
Jazz
glad that you
hands.
did it too. Like I'm always like, "Hello, everybody," and then the other person's always like, "Okay." So today I have Angela Barbash from Revalue on, and I am super excited because, well, I'm gonna try not to be getting too like rowdy, like, yeah, about every single thing that you say. Um,
No, do that. I like Tiger Claws for his commentary.
You know, saying when April Boyle was, I keep wanting to call this my show. April Boyle was
Is
on my,
this not your show? I feel like this is your show.
yeah, it's like my TV show. So when April Boyle was on, we had to quell those same exact feelings. But anyway, so so Angela is very cool. I feel like as far as the like support local businesses, support like a broad set of businesses, support underrepresented founders and minority-owned businesses. Like you're kind of like have been on this campaign
Journey.
on this journey. Yes, very good.
This like walking through the desert for 40 years.
Yeah, exactly.
That's what it feels like.
This ramble for a long time, and so I feel like you've got like just a ton of great insight, and I feel like Revalue is so cool too. Like so we'll talk about that a little bit. So if you want to maybe talk a little bit about your journey to starting Revalue and then what you guys do at Revalue.
Yeah. So first, thanks for having me. It's exciting to do a live stream on video. So hello to everyone who may tune in a bit or will watch this afterward. It's a pleasure to meet you virtually if I don't already know you. There's a lot of stories that we tell ourselves about our journeys, and they're all, through our own set of eyes and perspectives. And sometimes those stories can be inhibiting and sometimes they can be bolstering. And so I'm going to tell you a few of my stories, and they are what they are, for what that's worth. So I came out of, I like to say I came from the streets, or kind of out of the trenches. So grew up in a socioeconomic slice of the pie that was, like just every challenge you could imagine. I grew up with parents that didn't know how to manage finances, didn't graduate from college or from high school, rather, let alone college, didn't graduate from high school. Both went into the military because that was really the only out for them. On one side of my family, a migrant farm labor background, and on the other side of the family, just blue collar, kind of hustling background. But it was a really challenging upbringing. And so in all of that, in my teenage years, I fell in love with science and people and math. And at a time when like STEAM was not a thing, there was no acronym that we used to like advance women or girls in STEAM. And so I fortunately ran into a few key mentors along the way that kept me on the path of math and science and people, and in particular, the science of people. So for me, that turned into anthropology, a love of that, of history, and then just having an aptitude for numbers and being curious about all the things that we can openly talk about now, but at the time in the 90s and early 2000s were little understood by that upcoming generation. So I'll be 40 this year. So I'm a Gen Xer or Zennial, depending on which moniker.
I can't even figure it out anymore. I'm like,
yeah. So we just didn't talk about like why the power structures were what they were and why financial centers were what they were and how had these structures held everyone down. It wasn't common conversation at the time, but I could tell that money had a big part of this whole story, and I didn't understand money. So I was like, well, job one, let's go understand money. So that led me then into financial advising. And I thought, well, if I really want to understand money, like what better way than to be forced to learn about money in order to provide quality guidance to people about their money, which is a really bizarre way maybe to get into to learn a thing. But it worked. And fortunately, people in my 20s that were my clients had the patience for that partnership, and they were willing to teach and be led. So lead and be led. So it was very much a partnership with my clients and I. And so I did all of that in my 20s. And then right around like 30, I had which was like 2010, 2011. I had this like realization, this post 08 recession realization that things were changing, like tables were being flipped. And I think the flipping of the tables we're seeing today actually started then with Occupy Wall Street and the Tea Party in 08. And they just simmered under the surface. They never those people never went away. They felt the same way they feel today. They felt 10 years ago. And but what I could see was that the whole industry was being shook up. Philanthropy was being shooken up. The finance industry, investing not just to avoid sin stocks like alcohol, tobacco, and firearms, but investing for the world you want to see in the future, which is inclusive impact investing, community investing, social enterprise, like all these things were all starting to streamline together into this better world that we were all trying to forge. And what I wasn't seeing financial advisors being a part of that story. And I definitely was not seeing the financial advising industry and money management industry partnering with the economic development industry to advance a betterment of society. Like they were just very much siloed, and 10 years later they're still very much siloed. And so a lot of our work is like bridging the gap between econ dev and financial advising, wealth management. So anyways, I could wax on and on and on about this stuff, so I'm gonna pause now. But that's roughly
it is so interesting though. I love how you that's exactly what I was looking for. The exact response to the question that I was looking for. I was like, I want a journey. So Revalue's for people that don't know, Revalue's a values-based investment advisory firm. So I guess talk a little bit more specifically about like what that means.
Yeah, no, it's a good question because people might read that and be like, so you only serve Christian clients, or like, what does that mean? Okay. So we've gotten that question before. So what that means is that you as an investor, you might be trying to get advice from an investment firm or a financial planner that is going to meet your goals, but is also you might be interested in advice that's aligned with your values, and that's what we do. So people come to us and they say, here's my set of values. I don't want to invest in these things. I do want to invest in these things. I care about these things in the community. I care about these things in the world. Let's align all the financials, the investments, the charitable giving. Let's align it all with that like family mission, if you will. Now, one of the things, as you can imagine, in this journey of wanting to serve everyone and their values, you end up with people with conflicting values in our practice. And we've run into cases where people are like, well, if you're serving people that have those values, then I don't want to do business with you because that's in conflict of my values. So we had to, a few years ago, kind of take a step back and do like we call it our line in the sand conversation. Where's our line in the sand where like we will not violate these values? Like, you know, if you're like pro child labor, no. If you're like, you know, pro, there's a number of other examples. We came up with about a dozen criteria that were like, these are the things that violate our values that we will not help you do as a client. But mostly people can come, and we have yet to encounter someone that is like, you know, let's put kids to work kind of thing. Yeah. You know, that's pretty rare. But there is definitely conflicting values among our clients, and that's okay. Everybody is okay with that because everybody's got their own values. So that's what we do is we help them invest along their values.
I feel like it is really interesting too, of like just being a little bit more intentional with your investment strategy. Because I think there's a lot of people that are putting money in their retirement account or putting money in, like doing some angel investing or other types of investing. And I think like just taking it like one step further and being a little bit more intentional in like the types of sectors and the types of industries that you're investing in that can kind of then align with the things that you're hoping to promote in the world is like just seems like really obvious. But it is kind of funny that then it like, yeah, I guess, because then I was going to ask if you guys like have any sort of like influence on like, oh yeah, like, well, what are your personal values, and then those are the values that you want your clients to align with. So like that makes sense that you would have to have some boundaries at least, because otherwise it would be a little willy-nilly. But then you don't really want to be telling people like, well, yeah, you come to us if you want our values. It's like, no, like advising them along their values is cool. I like that.
It's like a constant balancing of our values versus their values, and trying to find alignment. And where there is misalignment, we're just not going to service that part of your value set necessarily. You can do that in other ways, but that won't be part of this work that we do with you. But yeah, it's fascinating. If you like to study people, and economics is the study of people, it's behavioral science, then this is the field for you.
Yeah, interesting. And then do you like what, I guess, like return profile makeup of your clients? Like, are most people looking for market rate returns, or are there some people that are kind of like will accept less than market rate because they're kind of like going after like
that's a great question.
Their mission specific or
Yeah, no, that's a great question. You can generally divide investors into two camps with regard to their public investments, and then two camps with regard to their not public investments. So I'll talk public investments first. There are people that are like, I want to make as much money as possible because I need to retire, or I need to send the kids to college, and like these are my goals, these are my values, and I'm okay with companies maybe not being as like the greatest, but they are doing some good things, and they're at least not doing the worst things, and so I'm okay with that. And then there are people that are like, if I make high returns and can retire, but the world is falling apart on the back of that, then that's not okay. And so they're much stricter. Like, I only want companies that are for sure not polluting the environment, not, they have no track record of that, that kind of thing. And so you get a bit of a like softness versus regimented with regard to public, but still people want to make at least what the S&P 500 is making, right? They don't want to lag the S&P 500. And then within private, the non-public stuff, so that would be community development finance institutions and like lending to them. Other types of intermediaries is what that type of or institution might be called, or local investments, local real estate, things like that. Then you get one half of the camp is saying, if you industry or marketplace, if you want me to take my money out of the public markets and put it into the private markets, then I need to get what's called a risk adjusted rate of return, which means I'm taking a higher risk, and therefore I need to make more money to compensate for that. And then there's another half of the market that's like, no, I'm investing for impact and for mission, and I'm fine with accepting below market rate, which would be like 1, 2, 3, 4% returns versus 8 to 12, 12 to 15, something like that. I'm okay with that because I want to be as least extractive as possible. And I would say more of our clients are in that camp of accepting below market rate returns. However, we do have a thesis internally that if the private markets can't return competitively with the public markets, then we will never see a meaningful shift of capital off of Wall Street and into Main Street.
Yeah.
So there's like that tension, like how much how much do we want to shift capital back into communities' hands, and who in the community is getting that capital and that wealth? So it's a much bigger conversation than what we could have here necessarily.
Yeah, definitely. I like that.
Yeah.
That is, I'll have to think about that more after.
Yeah. There's a lot to unpack there.
Yeah, I'm like, so I think like sort of the flavor of the day for a lot of people that are kind of not in the community that we're in, is like supporting local businesses. And a lot of people, like, because they're seeing their, favorite ice cream shop, favorite restaurant, favorite whatever, struggle right now, because of the pandemic related shutdowns. I think that we are seeing a lot of people like, how can I support my local businesses and help get them through this tough time? So, and I know that Revalue does like a ton of local investing education. So I guess, why do you feel like investing locally is so important, and how do people know if that investment strategy is right for them?
Okay. So first, why I think it's so important is that there are a lot of business owners in our community that are not bankable. They can't go to the bank. And that could be because they've got credit score limitations. That could be because they are in their first year or two of business and they just don't have enough of a history and track record. It could be because they have a record of incarceration, which then blocks them at the bank. It could be because they don't have any collateral to put down. And so if they can't go to the bank and they can't go to the angel group because they're not a high growth business, and they can't go to like a micro loan program with one of the economic development agencies because they're not like innovating a thing. They're a community service business in our, that is the ice cream shop or the restaurant or the dry cleaner or whatever. Those community-based businesses, they face a whole host of barriers. And so then the question is, well, where do they go? Well, traditionally, the answer by all of the types of organizations I just mentioned is go to friends and family. But if you are coming from generational poverty, like, what friends and family are you going to, right? Like, so that's been like the elephant in the room for the last 20 years, as everybody's like, friends and family is where you get that initial tranche of capital, or when you're in a pinch, or go to friends and family. Well, they can't. So what do? They take home equity lines of credit. They go to payday lending. Happens a lot for businesses, right? Astronomical 350% interest rates. Or they just don't go into business, or they go into business with a shoestring cash on hand, and then a pandemic hits or a tornado hits or a whatever hits, and now like they're out, and then everybody's like, well, you should have had more cash on hand. And it's like, so I get passionate about this.
Yeah,
so,
I know it does seem like just so impossible sometimes. And a lot of the research that we've been doing, like with you guys and with others, are like, is just like, I'm shocked by how many people are like, oh yeah, my primary source of capital is friends and family. And then it's just like, oh, well, yeah, then like, obviously there's
like that's great for the people that have friends and family with capital, but most people don't have friends and family with capital. So then what do you do? So there's an entire class of humans in our ecosystem, the entire middle class essentially, which is anywhere from, people that might have 50 to 100,000 in investments, all the way up to people that have $1 million or $2 million in investments. They have 99% of that capital is sitting on Wall Street, right? Making money for them, but also generating wealth for other very high net worth investors. And so the argument has always been for the last decade, and this is why the laws have started to change and all that, is if we just shifted even 1% of the $65 trillion we have in investments in wealth in this country, if we shifted even 1% of our portfolios back into community business ownership hands, we are not only allowing these businesses to to survive and thrive, but we are giving them the opportunity to build more wealth on the back of that capital that stays with them. Now there's some nuance about like who gets that wealth and, you know, that kind of thing where you're structuring the investment opportunity. But anyways, that's why I think it's so important that we are engaging everyone else in the community. And this is not just a institutions or friends and family are your only available options. Yeah. And then the second question was investor education.
It was how to, well, I have one other, I'm going to interject. Forget the second question. I'm going to interject a different one. Okay. Where do you feel like people should go to get more like local investing education? So people are kind of like interested in what you're saying and they're like, oh yeah, that seems like a thing I should do. Like, where should they go?
Okay, great. So there are, I would say, 3 primary websites that I got to get my like left to right, up to down, right in the camera because it's reverse. There are 3 primary websites that you could go to right now. The first is our website, which is whatisgrubstake.com, and that's grubstake.com. And that links off to a bunch of other resources. It links off to some videos we put up on YouTube, very introductory kind of language and resources. The second is here in Michigan, you've got crowdfundingmi.com, which is a website that is managed by the Michigan Municipal League and is more so directed toward public sector leaders in communities that would like to embrace community investing and local investing as a topic. And then the third website is localinvesting.org, which is the Local Investment Resource Center. And that was a site that was stood up almost a decade ago by a financial advisor on the West Coast and has just now come under the leadership of a different organization. And we're actually writing the content on that site for other financial advisors, because that's a big part of this is if you can't talk to your current financial advisor about it, like then you have to like go renegade without their guidance, which is not ideal. So those 3 sites will link you off to more. If you wanted to see specifically case studies, news articles, kind of like what's happening in the movement right now kind of thing, locavesting.com, loca vesting, like local investing, locavesting.com, which also is linked off of the Grubstake website, and Impact Alpha. Those are the 2 primary news sources. Locavesting is free. Impact Alpha requires a fee. The other websites are all free. And that's like the best that we have right now because it's still very much a work in progress to get education out there, because it's been the call for education has been embraced by some institutions that have been willing to put some funding behind it, like Michigan State University, but not at the level, like the regulatory level, like FINRA and SEC and the Financial Planning Association and NASA. Like there's so many institutions that could be including this topic in their continuing education efforts or in their investor education efforts, but it's not been picked up by them yet. So we're still very much in an early adoption stage on this, and we've been working at this for a decade, and it's still early adoption stage.
Yeah, I also feel like something you said earlier was like kind of just reminded me of like when people are investing locally, I think like they don't realize like the impact of that has on their local community as compared to like if they're investing like on the stock market. And so that 1% shift of like not only does it provide access to capital for the businesses that are in their local community, but also like a lot of times if you shop local or you invest local, the money that you're paying to that business then like is that person's salary that they're spending in their local community, or is like, you know, going towards services that they're giving to, you know, like a lot of times they'll like go towards services that they're doing in the local community. And it's also shown that like local businesses provide do a lot more like investment in nonprofits and like supporting local fundraisers and things like that. Like it's like something like 250% more than these larger companies who would never even hear about things that are happening in your local community. So I think like that is also like there's just so many additional like reasons why it's like better to support your local businesses rather than even like shopping wise, like shopping on Amazon is like literally just the worst thing you can do. I know I do it sometimes, but I try not to.
Almost. We're all of us are almost guilty of that, or almost all of us are guilty of that. Yeah.
Yeah, exactly. I'm like, I try, if you can find something locally, it's so much better to find it locally. And it's even better to shop like at your local Target than it is to go to Amazon. Like Amazon is like actually like causes so many, there's like, I could go on and on, but there's so many like shopping on Amazon is actually like a detriment to your local community and displaces local jobs. So it's like at least shop at Target.
Right.
There
at least
you go.
Hiring people. Yeah.
At least do that. Okay. Anyway, yeah. So then we'll go back to the second question that I had was how do people know if like local investing strategy is right for them?
Well, that's a great question. So I often advise people to at least have their emergency funds set aside. So for those of you who may be familiar with Dave Ramsey, I'm going to call up something that he's got out there. I personally am not a huge Dave Ramsey fan, but that's
I don't like
conversation.
But I kind of like his thing.
Right. Don't like him personally. I have a lot of issues with the advice that Dave Ramsey gives. However, there is one piece that I think has been really key to a lot of families over the years, and that is if you Google Dave Ramsey baby steps, you'll find this one-page handout that is like 10 things that here's what you do in order. And number one is have $1,000 in savings. And then it's like aggressively pay off debt and then contribute to the 401k, so on and so forth. So I would say local investment, if you wanted to do it, would be after emergency savings is there and after you've already you're making good headway on debt payoff. And so now you're starting to do 401k or do Roth IRA. You're starting to actually be able to make investments. That's where you could start with $100. You don't have to have a lot of money. That's the point of local investments, is that you can find the opportunities and you can link to those types of sites off of Grubstake's website. You can see the publicly listed opportunities that might be in Michigan or in your area or targeting a particular kind of impact like the local food shed. And you can see what the minimum investment requirement is. And some of them are $50 or $100 or $250. And I would say, start with one, right? It doesn't have to be, you don't have to have $10,000 to do it. Just start with one that is a lower minimum, that you feel comfortable, that if you lost that money, it's not going to tank your entire financial future. That's my generalized advice without knowing who you are. And all of that.
Yeah, I like that. That is cool. Yeah, I like a couple of weeks ago, Molly and I both went to this, or we didn't go. I say went to things now when I'm actually talking about doing this, looking at my computer, just to make myself feel good. I'm like, the other day we went to this Detroit soup. It was so great.
I heard that.
It was so good.
Got a ton of new people.
Yeah, and so they're doing so for the people that don't know, Detroit Soup is something that Build Institute puts on, and they have I think it's monthly. They'll do a monthly get together, and everyone pays $10 and $5 is they'll get soup and bread or whatever, and then the other $5 goes into a pot that they then give to one of 4 businesses that pitch at the event, and they're normally idea stage businesses, but it is now they're doing it virtually, so you just get your own soup and you just pay $5, but or you can pay more, but I always think that's such a cool way too for people to kind of just tip a little $5 toe in the water and see, and they get such great businesses from across a large spectrum of industries and all of that are participating in that. So I'm always but then I'm such a sucker for local business, small business types, founder, fangirl, that of course when they give the money away at the end, I always cry. I'm always
That's awesome. I think I've cried at every, you're not the only one. I've cried at every soup event I've gone to.
Literally tearing up right now, even remembering about it.
It's emotional. It's emotional. No, it's not dumb. It's emotional, right? Like these people are getting an opportunity to be heard with their vision in spaces that have not, like there are not other spaces that have been open to people or have been comfortable for people that also had capital on the back end. It wasn't it wasn't like a pitch competition and, all of that. So I love the soup events. And that brings up another baby step option that is actually run by Build Institute, and that is Kiva Detroit. Kiva is a global organization and has been doing really wonderful microfinance work all over the world for a very long time, and have proven or like dispelled the myth that especially low income women are high risk, because they're not. And Kiva proved that, and Grameen Bank proved that the repayment rates are in the high 90s, like percentage wise. And so it's a myth that poor people, I hate that term, but people that are economically depressed, that they can't manage to pay back loans, because they can. But anyways, I digress. So Build is the partner for Kiva Detroit, and the way that Kiva got around the securities laws is that when you lend $100 to a business on the Kiva platform, you get no interest repaid to you. You just get your return of principal. And most people, what they'll do is they'll deposit like 50 or $100 or 200, whatever they feel comfortable with, and they'll lend it. And as it gets paid back, they just keep lending it out. And so they've got their own little like revolving loan fund, 0% interest. And that's a great way to test the waters of like, how do you feel about taking this risk with your money and that kind of thing. I was talking to Evan Adams recently from Build about the Kiva program, and he was telling me that in COVID, like pre-COVID, a business would post a capital raise for like $5,000 or $10,000, and the raise would be live for maybe 20 days on average. Like that's how long it would take for investors to show up and to fund that campaign goal. And during COVID, those close out in 4 days now. 4 days. That's how accelerated the community response has been to businesses in need, which has been phenomenal. Because I was asking him, like, why is it that every time I go onto the Kiva platform to try to place client capital, I show up 3 days later and it's gone? He was like, well, that's because they're doing great. And I was like, well, that's a good problem to have.
Yeah, that is really good. That is so good. We're doing like some work with those programs right now, and I'm like very interested to like learn all of the things, because those I think it's like such a cool both like Kiva and Detroit Super like doing such good work in the community, and like also like increasing access to capital for Black owned businesses, for minority owned businesses, women owned businesses. Like it's just like the amount of like people that are starting businesses and stuff that you typically don't necessarily see through the traditional channels that are getting access to capital that way. And it's like you kind of like shift from looking at like the traditional like bank, venture capital, angel investing, and then you like look over and you're like, oh yeah, this is the profile of people that start businesses. And then you like do one Detroit Soup and you're like, oh damn, that's where everyone is at.
Yeah.
So that's like really cool. Anyway, I'm going to end up, it's going to be like 11 p.m. by the time I get through all my questions. So we'll sort of wrap up with this question. Do you feel that values-based investing, impact investing, or more community-based spending or investing are more important now as we kind of continue to operate through this pandemic?
Yeah, absolutely.
Yes. Goodbye.
Like, obviously. No, I can give you a couple of key thoughts on that, and then I've got a particular self-interested message that that is not just for me or for us, but it's for a lot of other people too. So ESG, so community investing sits inside of this broader movement around ESG and SRI. That movement, and ESG stands for environmental, social, and governance criteria by which companies are screened against. SRI stands for sustainable, responsible impact investing. Those are slightly synonymous terms, but community investing is like inside of this massive movement that had already been gaining steam in the last, like started in the 80s, really gained some steam in the 90s, got legitimized in the 2000s through a lot of studies by big financial institutions that were trying to prove that by voting with your conscience, with your dollars, you are leaving money on the table. and what they found was that that wasn't true. That was a myth. And during COVID, actually, SRI driven companies or mutual funds are actually outperforming. Big surprise, because those companies are more resilient because they're thinking about more than just the bottom line, the financial bottom line. So in the last decade, that whole movement has been growing, and it's gotten to the point now where the entire finance industry and regulators are starting to acknowledge that not caring about the other facets of what a company does and the impact it has in the world on both the people that work there, its supply chain, its consumers, the environment, not caring about those things is actually a breach of fiduciary duty. And they're just on the edge of like definitively saying that. And what that means is if that is considered, if ignoring all of that is considered a breach of fiduciary duty, that has implications, I think, for all of the institutions that are like mission-driven institutions that are like, foundations, endowment funds, all of these like mission-driven institutions that are getting tax incentives or tax breaks rather for being nonprofit. They all have big investment portfolios, and if there's a misalignment there, they could potentially be viewed as being in breach of fiduciary duty as trustees. So that has massive implications.
Yeah.
If we keep going in this direction, I think we will, then we could see in the next decade that's the flip that's happening, and then SRI becomes the standard, impact becomes the standard, and one of our founders at Revalue likes to say, Pavan, he likes to say that I'd like to get to a place in the world where you don't have to qualify an investment by being an impact investment, because an investment, if it's not having a positive impact and it's having an extractive negative impact, it should not be called an investment. It's not an investment. If it's destroying value, then it's not an investment. If it's generating value, then it's an investment. So I think that's where we could be going in the next decade. And the pandemic just highlighted that, or like really brought that into focus, how important it is that we are caring about all the people in our community and the planet, in addition to making money, that it's not an either or, it's a both and. So that's why I think it's super important. My drum that I've been beating, and I want to beat here if you let me, is that I'm seeing this disconnect in the community with people and institutions who are paying for financial services help, right? They're paying for investment management guidance. They're paying for fund management, financial planning guidance. They're already sending that money out the door, and they're choosing to send it out the door with institutions that are not having a direct impact in their own backyard. But then at the same time, they also are embracing a buy local vibe, right? So if you are going to buy locally in retail and with food, you have to do it with your professional services also, right? Your financial planning and investment management guidance, which obviously is our self-interest there, your accounting services, your legal services, your HR services, all of these technical assistance providers are in your own backyard. And there's many of them that are led by people of color, women, immigrant, heritage, so many, being on the east side of the county like us, that you could be lifting up your community just by shifting your purchasing. And so it is maddening to be a woman of color coming from depressed socioeconomic background, being young, like next gen, being on the east side, choosing to locate our business on the east side of the county, which is economically depressed, so that we could hire locally and have the biggest impact locally. it is maddening to have all these attributes but still get the door slammed in our face because we're not from Boston, because we're not from LA, because we're not from New York, and watching all this money just leaving our state, leaving our community, and this is not the only sector that's happening in.
Yeah, exactly.
And I'm just like, this doesn't even make any sense. Right?
Yeah, I do think people do kind of forget that when they're like talking about like buy local, shop local, like they're thinking to themselves like, oh, I'm trying to like buy at my local toy store and I'm trying to like buy at my local coffee shop, or go to my local restaurants. But there's like all these other small businesses that are in like service industries and things like that
mortgage lenders, realtors, title companies, a lot of them, and choosing to go with an independent firm that's in your own backyard, that is aligned with your values, that should be right up there in the buy local conversation. But I often am not seeing it. So that's my plug.
Yeah, and 90% of businesses have 25 or fewer employees, and it's like something like 80% have fewer than 10 employees. And so it's like most people work at a small business. So when you're thinking buy local, like the job creation, like net new job creation comes from small businesses. Most of it comes from small businesses. Like all of these things, like you really do have to think of it like more holistically than just buying some coffee. But although I do love buying some local coffee. It's okay.
You and me both. Shout out to Cultivate for my
local
coffee and Ruse Roast. Yeah.
Yes. Okay, sweet. Well, then I will probably be talking to you within like a couple of days. But I talking to you on video. And thanks so much for taking the time. And I know you've got you've got some world saving to do. So
thanks for having me and letting me rant about the things that I know. I love it. Passionately rant about. And thank you to everyone that listened in on this. And I hope that you learned something new. If you want to get in touch with us, revalueinvesting.com.
Yay, perfect. Thanks. I will talk to you soon.
Okay, bye. Bye.
Bye.
Bye.